Hello everyone, I'm delighted to be with you here today to discuss the book building conduct requirements for issuers and intermediaries involved in book building and placing activities. These came into effect on August 2022 under paragraph 21 of the SFC's Code of Conduct for persons licensed by or registered with the SFC, and I'll refer to this as the Code of Conduct. I'll also be talking about these requirements as the book building conduct requirements, or paragraph 21 in this webinar. I'll also be discussing the amendments to the main board and GEM listing rules that the Hong Kong Exchange made to complement the book building conduct requirements. We'll begin today by looking at an overview of the SFC's concerns relating to Hong Kong's book building and placing activities and the market practices that they said led to the book building conduct requirements. I'll then look at the listing rules which reflect and complement these requirements. In February 2021, the SFC published a consultation paper with two main proposals. The first was a proposal to introduce the book building conduct requirements, which aimed to clarify the roles played by intermediaries conducting book building and placing activities in equity and debt capital market transactions, and to set out the standards of conduct expected of them in Hong Kong book building, pricing, allocation, and placing activities. The second was the sponsor coupling proposal, which requires at least one head of the underwriting syndicate of main board IPOs or a company within the same group to also act as an independent sponsor to the IPO. The SFC had reviewed the conduct of licensed intermediaries engaged in book building and placing activities in equity and debt capital market transactions prior to issuing its proposals. During its review, the SFC found that in some offerings, the price discovery process had been hampered by various factors such as inflated or opaque demand. The SFC identified cases of what it considered to be undesirable intermediary conduct, such as brokers without a mandate swarming order books at the last minute with orders of what the SFC referred to as unknown quality, which could be price insensitive orders from corporates and individuals. During its review, the SFC also found that sponsors' fees were often misaligned with sponsors' costs and liabilities, particularly in larger IPOs. According to the SFC, this raised concerns that IPO sponsors may have compromised their due diligence work to become the head of the underwriting syndicate and thereby earn much higher underwriting fees in order to compensate for sponsors' costs, responsibilities, and potential liability. The SFC identified a number of concerns with the book building and allocation process in Hong Kong, including that the roles and functions of various intermediaries were not clearly defined, and that fee arrangements and syndicate memberships were often determined at a late stage, sometimes only shortly before the publication of the IPO prospectus. The SFC was also concerned that the order book lacked transparency, which prevented syndicate heads from assessing real demand or identifying unusual or irregular orders. The SFC and the Stock Exchange subsequently issued a joint statement in May 2021 on IPO-related misconduct, setting out issues they'd identified in recent listing applications. These included an increasing number of ramp and dump schemes in IPOs, particularly in IPOs of companies with smaller market caps. Ramp and dump schemes are a form of market manipulation, often conducted via social media, where fraudsters use various methods to inflate the share price, to induce investors to buy the shares and subsequently dump the shares at an artificially high price before the share price eventually drops far below its IPO price. The regulators suspected that some of these schemes were initiated at the IPO stage with a view to manipulating the share price later. Shares were apparently sometimes allocated in the placing tranche to controlled accounts, funded by unusually high underwriting commissions or other listing expenses. After an initial rise in the share price after listing, the share price would drop significantly. The SFC was also of the view that the placing tranche was sometimes used to allocate IPO shares to controlled placees in order to artificially meet the stock exchange's listing requirements or to facilitate market manipulation post-listing. It also pointed to the lack of a robust and transparent share placement and price discovery process as contributing to the difficulty in identifying suspicious cases. The SFC had also observed that the payment of unusually high underwriting commissions was often a feature of problematic IPOs. For example, the average underwriting commission rate for IPOs with a market cap of less than 600 million Hong Kong dollars reportedly rose to 12% in 2020, from around 4% in 2017. The SFC suspected that high underwriting commissions were used to fund arrangements aimed at satisfying the stock exchange's listing rule requirements, including the minimum market cap, sufficient investor interest, and adequate spread of shareholders' requirements, or perpetrating ramp and dump schemes. Listing applicants' payment of substantial amounts of additional discretionary listing expenses after listing was also highlighted as suspicious. The SFC published its consultation conclusions for the book building conduct requirements in October 2021, and in August 2022, the book building conduct requirements under the Code of Conduct and related amendments to the listing rules took effect. Paragraph 21 of the Code was developed and included in the Code to set out various obligations and expected standards of conduct of SFC licensed or registered intermediaries involved in Hong Kong book building and placing activities, or advising issuers on these activities. These intermediaries are referred to as capital markets intermediaries, or CMIs, and I'll use this terminology going forward. Before conducting any book building or placing activities, CMIs must be formally appointed under written agreements setting out their roles, responsibilities, fee arrangements, and fee payment schedules. Fee arrangements are to be determined at an early stage, and OCs must also be appointed at an early stage, as I'll discuss later. For main board IPOs, sponsor coupling is required. This means that at least one overall coordinator, often referred to as an OC, must also be appointed as a sponsor, or be a member of the sponsor's group of companies, and this sponsor must be independent of the issuer. OCs are the heads of syndicates and are a type of CMI. They must also advise the issuer client on marketing, strategy, pricing and allocation, and ensure transparency in the price discovery process. The SFC has updated its guidelines to sponsors, underwriters, and placing agents involved in the listing and placing of GEM stocks, which were originally issued in January 2017. The guidelines, which are called the Guidelines to Capital Market Intermediaries involved in placing activities for GEM stocks, provide general guidance for OCs and guidance for CMIs when placing shares to their investor clients. I'll now move on to discuss the book building conduct requirements in more detail. So the book building conduct requirements apply to SFC licensed or registered intermediaries that engage in providing services to issuers and or to investors in relation to offerings of shares or debt securities which involve the conduct in Hong Kong of book building activities, placing activities, and or advising, guiding, and assisting the issuer client in Hong Kong book building and placing activities. SFC licensed or registered intermediaries engaged in any of these activities are referred to as capital market intermediaries, or CMIs, and that's how I will refer to them going forward. Book building activities are defined as collating investors' orders, including indications of interest in an offering, in order to facilitate the price determination and the allocation of shares or debt securities to investors, or the process of assessing demand and making allocations. Placing activities are defined as marketing or distributing shares or debt securities to investors pursuant to book building activities. The book building conduct requirements also apply to those advising, guiding, and assisting the issuer client in Hong Kong book building and placing activities. CMIs that are subject to the book building conduct requirements do not include financial advisors or other professionals who only provide advice to the issuer, but do not participate in any book building or placing activities. Paragraph 21 of the Code of Conduct covers certain types of share and debt offerings that involve Hong Kong book building activities. These are offerings of shares listed or to be listed on the Hong Kong Exchange, including IPOs, including share offerings in connection with secondary listings and offers of existing shares by way of IPO, offerings of a class of shares new to listing, offerings of new shares of a class already listed under a general or special mandate, and the placing of listed shares to third-party investors by an existing shareholder that has a top-up subscription by the existing shareholder for new shares in the issuer, and offerings of debt securities listed or unlisted which are offered in Hong Kong or otherwise. All references to shares in paragraph 21 also include depository receipts and units or interests in SFC authorized REITs which are listed or to be listed in Hong Kong. Offerings which do not involve book building activities are not within the scope of the book building conduct requirements and are therefore not covered. Examples of these offerings are bilateral agreements or arrangements between the issuer and the investors, sometimes known as club deals, transactions involving only one or several investors, where the terms of the offering are negotiated and agreed directly between the issuer and the investors, sometimes referred to as private placements, and transactions where shares or debt securities are allocated to investors on a predetermined basis at a predetermined price. So what is a CMI? Well, a CMI is classified as either a syndicate CMI or a non-syndicate CMI, depending on whether it has a mandate and a direct relationship with the issuer. A CMI which is directly engaged by the issuer of a share or debt offering is referred to as a syndicate CMI. Examples of titles or roles associated with syndicate CMIs include global coordinator, book runner, or lead manager. In the case of less senior syndicate CMIs, co-managers and placing agents. A CMI which is not directly engaged by the issuer of a share or debt offering is referred to as a non-syndicate CMI. Examples of titles or roles associated with non-syndicate CMIs include sub-placing agents engaged by syndicate CMIs or other non-syndicate CMIs for the placing of shares or debt securities, and brokers which only collate orders received from their investor clients, place them with the syndicate CMIs, and distribute the securities to their clients if they receive allocations from the syndicate CMIs. A non-syndicate CMI, which is not appointed by a syndicate CMI and therefore does not receive remuneration directly or indirectly from the issuer client and is only responsible for relaying investor clients' orders to the CMI for placing into the order book, is not subject to the full set of obligations applicable to CMIs under the book building conduct requirements. Execution-only non-syndicate CMIs are only required to comply with certain obligations relating to the assessment of investor clients, transparency of the order book, the disclosure of any rebates offered to CMIs, and any other preferential treatment of CMIs and targeted investors, and the prohibition on offering rebates to investor clients. There are many types of share and debt offerings which vary in nature and complexity, and a CMI may play different roles in different offerings. A CMI's senior management is responsible for establishing and implementing adequate and effective policies, procedures, and controls to ensure compliance with the regulations and rules which apply to the roles they play in an offering. So what is an overall coordinator, or OC? Well, OCs act as the head of a syndicate for an offering, although whether or not a CMI is an OC is determined solely by reference to the activities it carries out rather than by its title. For a share offering, an OC is a syndicate CMI which solely or jointly with other OCs is responsible for the overall management of the offering, coordinating the book building or placing activities conducted by other CMIs, exercising control over book building activities and making allocation recommendations to the issuer client. They may advise the issuer client of the offer price, and they may be a party to the price determination agreement with the issuer client. Or they exercise discretion to reallocate shares between the placing tranche and public subscription tranche, reduce the number of offer shares, or exercise an upsize or over-allotment option. In the case of a debt offering, an OC is a syndicate CMI which solely or jointly with other OCs conducts the overall management of the offering, coordinates the book building or placing activities conducted by other CMIs, exercises control over book building activities, and makes pricing or allocation recommendations to the issuer client. Turning now to the obligations and standards of conduct required under the book building conduct requirements, the obligations and expected standards of conduct or baseline requirements that are applicable to all CMIs, including OCs, are set out in paragraph 21.3 of the Code. Paragraph 21.4 of the SFC Code of Conduct sets out the additional requirements which are applicable to OCs only. It's not possible to go through all of these requirements in this webinar, so I'll go through some of the key obligations and requirements in a moment. Let's first look at the requirement for conducting an assessment of the issuer and the offering. Paragraph 21.3.1 of the SFC Code of Conduct requires all CMIs to conduct an adequate assessment of an issuer before engaging in an offering for that issuer. This requires the CMI to take reasonable steps to obtain an accurate understanding of the issuer's client's history, background, business and performance, financial conditions and prospects, operations and structure. This is intended to provide CMIs with a proper understanding of the issuer and the offering, which is necessary for CMIs to market the shares or debt securities to their investor clients and for the OC to provide appropriate advice to the issuer. Where the CMI for a debt offering acted as the CMI for previous debt offerings made by the same issuer, the CMI will instead be required to ascertain whether there have been any material changes in the client's circumstances that are relevant to its role as CMI. CMIs are also required to establish a formal governance process for the review and assessment of the offering, including any actual or potential conflicts of interest between the CMI and the issuer client and the associated risks. The book building conduct requirements contain provisions on the timing of appointments of CMIs and OCs and stipulate that appointments must be made under written agreements setting out the fee arrangements. Prior to the rule changes on book building and placing activities, the previous practice typically was for underwriting agreements for share offerings and subscription agreements for debt offerings to be entered into very late in the offering process, usually when the price had been fixed and allocations to investors had been finalized. Underwriting agreements did not generally define the roles and responsibilities of CMIs. Underwriting agreements for share offerings typically specified intermediaries' underwriting commitments, which did not necessarily correspond to their fee entitlement. In debt offerings, it was also the norm to appoint syndicate heads verbally without written agreements. To address what the SFC regarded as issues, the book building conduct requirements require that before CMIs conduct any book building or placing activities, they must have been formally appointed to conduct these activities under a written agreement by the issuer, in the case of a syndicate CMI, or by another CMI in the case of a non-syndicate CMI. The written agreement must clearly specify the roles and responsibilities of the CMI, the fee arrangements, and the fee payment schedule. The fee arrangements in a CMI's written engagement agreement are required to set out the fixed fees payable to the relevant CMI as a percentage of the total fees to be paid to all syndicate CMIs participating in the offering. Total fees for these purposes include fees for providing advice to the issuer, marketing, book building, making pricing and allocation recommendations, and placing the securities with investor clients. Total fees, which are often referred to as underwriting fees by the industry, must include all fixed and discretionary fees to be paid in relation to activities covered by paragraph 21 of the Code of Conduct. A fee payment schedule must also be set out in the underwriting agreement. For OCs, before they conduct any of the activities set out in paragraph 21.2.3 of the SFC Code of Conduct, that is, any of the activities to be classified as an OC in a share offering, or participate in any book building or placing activities for a debt offering, the OC is required to ensure that it has been formally appointed by the issuer under a written agreement to conduct these activities. The written agreement must include the same information in relation to the fee arrangements as is required for all CMIs. For mainboard IPOs only, at least one sponsor which is independent of the listing applicant must be appointed as an OC for the IPO, or have a group company which is also appointed as an OC for the IPO. Both appointments must be made at the same time, at least 2 months before the filing of the listing application. This is referred to as sponsor coupling and is intended to identify one or a small group of senior syndicate members from the outset in order to ensure consistency in the advice provided to the issuer and to inform market participants of who, apart from the issuer, is primarily accountable for the IPO and for the provision of accurate and reliable information, and to alleviate concerns that if sponsors are not appointed as a head of the syndicate from the outset, they may be incentivized to compromise due diligence to secure the appointment given the fees associated with that appointment. Other OCs who are not sponsors to an IPO and OCs of GEM IPOs must be appointed no later than 2 weeks after the listing application submission. As I will discuss later, the names of all OCs and their fee arrangements need to be provided to the SFC by no later than 4 business days prior to the listing committee hearing to allow the committee to make inquiries. The requirement for the early appointment of OCs aims to ensure that OCs are given sufficient time to understand the issuer, develop marketing, pricing and allocation strategies, and properly coordinate the activities of the other syndicate CMIs in the offering. This requirement is not applicable to syndicate CMIs who are not OCs. Non-OC syndicate CMIs are only required to be formally appointed under a written agreement specifying the fee arrangements and fee payment schedule prior to conducting any book building or place activities. However, the identity of non-OC syndicate CMIs and their determination of their fees do not need to be reported to the SFC before the listing committee hearing. Instead, the OC must disclose the total fees as a percentage of the gross funds raised and the ratio between the fixed and discretionary fees to be paid to all syndicate CMIs to the SFC. This information must be disclosed to the SFC 4 business days before the listing committee hearing. As I mentioned, the written engagement agreement entered into between the issuer and each CMI, including each OC, must state the fixed fees payable to the CMI as a percentage of the total fees, including fixed and discretionary fees to be paid to all syndicate CMIs participating in the offering. So that means the fee split ratio. Fixed fees are the minimum amount of fees payable to the CMI, which is not subject to the discretion of the issuer, other than due to a change in the offer size or offer price. Any other fees which are payable as part of the total fees are considered to be discretionary fees. Any fixed fee entitlement that's expressed in the agreement to be subject to the discretion of the issuer will be regarded as discretionary fees. The intention behind the requirement for the fixed fee entitlement for each syndicate CMI to be determined at an early stage, that is, at the time of their appointment, is to allow syndicate CMIs to focus their efforts and devote their resources to conducting book building and placing activities in compliance with the requirements. The requirement was intended by the regulators to enhance transparency and credibility in the price discovery and allocation process. This requirement will invariably mean that the issuer has to decide prior to engaging the first syndicate CMI the total fixed fees payable to all syndicate CMIs and the total discretionary fees, if any, that may be paid to syndicate CMIs. An OC participating in a share offering is required to provide guidance to the issuer on the market practice on the ratio of fixed and discretionary fees to be paid to syndicate CMIs participating in an IPO. The SFC's consultation conclusions said that this was 75% fixed and 25% discretionary. For example, 3% fixed fees with the discretion to offer a further 1%. This is confirmed in FAQ 16 of the Exchange's Guide for New Listing Applicants, which also provides that issuers are required to assess whether they should deviate significantly from the 75-25% ratio, and that the regulators may make inquiries about any significant deviation from that ratio, following its reporting 4 clear business days prior to the listing committee hearing. FAQ 16 to the Exchange's Guide for New Listing Applicants provides guidance on how fixed and discretionary fees can be expressed in engagement agreements. According to the guidance, if a syndicate CMI's fixed fee entitlement is expressed as no less than X% of the total fees, the CMI's fixed fees would be regarded as X%, and any fees above X% would be regarded as discretionary fees. If the CMI's fixed fee entitlement is stated as no more than X% of the total fees, there's no certainty as to the minimum amount of fee that the CMI may get after rendering the specified services, and so the entire fee is considered discretionary. This does not comply with the relevant requirements and is not allowed. Where a fixed fee entitlement is expressed as a percentage range of the total fees, the minimum fee prescribed by the range would be regarded as the fixed fees of the CMI, while any additional fees within the range would be regarded as discretionary fees. Where the fee arrangement is expressed in the form of a tiered commission structure, where a higher commission rate will apply when the deal is priced higher, the minimum fee prescribed by the tiered commission structure would be regarded as the fixed fees of the CMI, and any fees above that minimum fee would be regarded as discretionary fees. This type of fee arrangement must be clearly disclosed in the IPO listing document. Discretionary fee entitlement, on the other hand, can be expressed using this type of language. OCs are regarded by the SFC as being in the best position to advise the issuer and as the parties who should be responsible for advising on the offer price and making allocation recommendations. An OC is required to act with due skill, care and diligence when providing advice, recommendations and guidance to issuer clients, including in respect of marketing strategy, pricing and allocation. Its advice and recommendation should be balanced and based on thorough analysis and should take into account the preferences and objectives of the issuer with respect to pricing and desired shareholder or investor base, which they should gain an understanding of through engagement with the issuer. An OC should also explain its allocation policy and recommendations, as well as key factors which could influence pricing outcome. These obligations are aimed at reducing incidents of OCs favouring preferred clients on hot IPOs, as well as the risk of underpricing to enable investor clients to subscribe at a lower cost against the interests of the issuer. OCs are also required to advise and guide the issuer and its directors as to their responsibilities under the stock exchange's requirements, which apply to placing activities, and take reasonable steps to ensure that they understand and meet those responsibilities. OCs must also explain the potential concerns and advise issuers against any decisions contrary to the OC's advice and recommendations which may lead to a lack of an open market and an inadequate spread of investors, or which may negatively affect the orderly and fair trading of shares on the secondary market. An OC should also explain the potential concerns and advise the issuer client against making decisions where the issuer client decides not to adopt an OC's advice or recommendations in respect of pricing or allocation of shares or debt securities. The OC should document any final decisions of the issuer client which deviate materially from the advice or recommendations provided by the OC, including the OC's explanation to the issuer client of any concerns associated with the decisions and advice provided. An OC is required to devise a marketing and investor targeting strategy for order generation based on discussions with issuers regarding their preferences and objectives concerning the shareholder or investor base. The strategy should specify the types of investors targeted, such as institutional, pension funds, hedge funds, family offices, high net worth and other retail individuals, including cornerstone investors for an IPO, and the portion of the offering to be allocated to each type of investors. On an IPO, the strategy should aim to meet the Hong Kong Exchange's listing rule requirements for an open market and an adequate spread of shareholders. The OC should advise the issuer on necessary adjustments to the marketing strategy in response to changing marketing conditions and sentiment. The OC is required to inform the other syndicate CMIs of the marketing and investor targeting strategy and any changes to it. CMIs are required by paragraph 21.3.3 to assess whether their investor clients fall within the types of investors targeted in the marketing and investor targeting strategy formulated, and should only market to investor clients that are targeted investors. For a share offering where the shares are only marketed to selected investor clients based on their suitability and investment preference, the CMI should be satisfied that the shares have been marketed to a sufficient number of clients and the likelihood of undue concentration of holdings is reasonably low. A CMI should generally allow all of its investor clients, which are targeted investors and have indicated an interest in an offering, to participate in that offering. The allocation of shares to certain groups of investors, such as connected clients of OCs, CMIs and other distributors, and core connected persons of the issuer, is either restricted or requires the prior consent of the Hong Kong Stock Exchange under the provisions of the listing rules. The Code of Conduct refers to these types of investors as restricted investors and requires CMIs to take reasonable steps to identify restricted investors and inform the OC before placing an order on behalf of these clients. As CMIs will typically not have access to all the information they need to identify the issuer's core connected persons, an OC is required to advise the issuer to provide all syndicate CMIs of an IPO with a list of the issuer's directors, existing shareholders, their close associates and nominees engaged by them to subscribe or purchase shares offered in the IPO. An OC also has an obligation to take reasonable steps to identify investors who are on that list and to ensure that any allocation to them is made in accordance with the requirements of the stock exchange. Under the Code of Conduct, a CMI must take reasonable steps to ensure that all orders, including indications of interest, placed in the order book represent bona fide demand of its investor clients, itself and its group companies. It must make inquiries with investor clients about orders which appear unusual, for example, an order which is not commensurate with their financial profile prior to placing the order. A CMI also has an obligation to ensure transparency in the book building process and is required to disclose the identities of all investor clients in an order book, except those placed on an omnibus basis. For orders placed on an omnibus basis, a CMI is required to provide the underlying investors' names and unique identification numbers to the OC and the issuer client when placing the orders. However, due to concerns about client poaching, OCs cannot use client information provided by syndicate CMIs for purposes other than placing orders in the share or debt offering. With overall responsibility for managing the book building exercise and having been provided with investor client information from other syndicate CMIs, OCs are required to take reasonable steps to properly manage an order book and ensure the book's transparency. This involves steps such as ensuring that the identities of all investor clients are disclosed in the order book, except where orders are placed on an omnibus basis, and consolidating the order book by taking reasonable steps to identify and eliminate duplicated orders, inconsistencies, and errors. OCs are also required to make inquiries with CMIs which have placed orders which appear unusual or irregular, such as orders which appear to be related to the issuer client, and to clearly identify in the order book and book messages any proprietary orders of CMIs and their group companies. Conflicts of interest between the issuer and the CMI or its investor clients could lead to underpricing or overpricing. In order to address these concerns, CMIs are required to establish and implement an allocation policy to ensure a fair allocation of shares or debt securities to their investor clients. This allocation policy is expected to be general and broadly suited for most share and debt offerings and should take into account the principles of the book building conduct requirements on conflicts of interest and proprietary orders. Take into account factors such as the marketing and investor targeting strategy, the order size and circumstances of the investor client, and prevent practices which may result in unfair treatment of investor clients or knowingly distort demand for other offerings. OCs are required to take all reasonable steps to ensure that the price discovery process is credible and transparent, and that the allocation recommendations made to the issuer client as well as the final allocation have a proper basis. In particular, OCs are required to advise the issuer on pricing with reference to the results of the book building, prevailing market conditions and characteristics of the issuer, ensure that the proprietary orders of CMIs or their group companies will not negatively impact the price discovery process, and develop and maintain an allocation policy which specifies the criteria for making allocation recommendations to the issuer client, taking into account factors such as the issuer's objectives and preferences, prevailing market conditions, the spread of investors, and the overall subscription rate for the offer. For an IPO, OCs are required to ensure that allocation recommendations are made with a view to achieving an open market, an adequate spread of shareholders, and the orderly and fair trading of the shares in the secondary market, and to ensure that any allocations to restricted investors comply with the listing rule requirements. As we saw earlier, restricted investors are investors such as connected clients and core connected persons of the issuer to whom share allocations are subject to restrictions or require prior consent from the stock exchange. If the allocation recommendations materially deviate from the OC's allocation policy, the OC should explain to the issuer client the reasons for the deviation. OC should also explain to the issuer client the basis of its advice and recommendations, including any advantages and disadvantages. Under the book building conduct requirements, CMIs are prohibited from offering any rebates to investor clients or from enabling any investor clients to pay a price lower than that offered to other investors. In particular, CMIs are prohibited from offering any rebates to investor clients or passing on to their clients any rebates provided by the issuer. On an IPO, CMIs are not permitted to enable any investor clients to pay a price lower than that offered to other investors, that is, any amount less than the consideration disclosed in the listing document. CMIs are also required to disclose to the issuer client, the OC, all their targeted investors and the non-syndicate CMIs they appoint, any rebates offered to CMIs, and any other preferential treatment, such as guaranteed allocations given to any CMI or targeted investors. OCs are also required to advise issuers against entering into any arrangements which, on an IPO, would allow any investors to pay less for the shares than the price disclosed in the listing document, or on a debt offering would result in investors paying different prices for the debt securities. In addition, OCs are required to advise the issuer of the disclosure of any rebates and preferential treatment and in accordance with the general requirement to disseminate material information related to the offering of all syndicate CMIs, will be required to disseminate information on rebates and preferential treatment to all syndicate CMIs. Throughout the offering, CMIs will receive information from the issuer, OCs, other CMIs, and their investor clients, which materially affects the offering, including information about the offer price and the ways in which the OC and CMIs should discharge their responsibilities. CMIs are required to disclose complete and accurate information in a timely fashion on the status of the order book and other relevant information they receive to the OC, whether directly or indirectly, and non-syndicate CMIs they appoint so that they can perform their duties as well as to the CMI's targeted investors so they can make an informed decision. OCs are required to inform other syndicate CMIs of the issuer client's marketing and investor targeting strategy and to disseminate material information related to the offering and ensure that the disseminated information is complete and accurate and has a proper basis. Material information related to the offering includes, for example, information which may affect the prices, orders received per investor type, proprietary orders of CMIs and their group companies, and known preferential treatments and rebates. In terms of record keeping, CMIs are required to maintain books and records sufficient to demonstrate compliance with all applicable requirements as set out in paragraph 21. The matters CMIs are required to document include assessments of the issuer client, the offering and investor clients, audit trails from the receipt of orders, the placing of orders in the order book, through to the final order allocation, all key communications with the issuer client, investor clients, the OC and other CMIs. Where a CMI's order is placed on an omnibus basis, the intended basis of allocation for all orders, with justifications and any material deviations from the CMI's allocation policy. All key communications with the issuer client, rebates offered by the issuer clients and the payment details, other preferential treatments offered, if any, and information forming the basis of all submissions made to the exchange and the SFC. They must maintain these records for at least 7 years, except for audit trails, which are only required to be kept for 2 years. OCs are required to document various matters, including all changes in the order book throughout the book building process and all key discussions with and key advice or recommendations provided to the issuer client, and they have to maintain these records for at least 7 years. In addition to general requirements under the Code of Conduct to avoid conflicts of interest, CMIs are required to establish, implement, and maintain policies and procedures to identify, manage, and disclose actual and potential conflicts of interest which may arise over the book building process. Always give priority to fulfilling investor clients' orders over their own proprietary orders and those of their group companies. Ensure that proprietary orders would not negatively impact the price discovery process and only be a price taker in relation to proprietary orders or those of their group companies, and segregate and clearly identify their own proprietary orders in the order book and book messages. For a debt offering, CMIs will be required to take reasonable steps to disclose to the issuer client how any risk management transactions it intends to conduct for itself, the issuer client or its investor clients, will not impact the debt securities pricing. General Principle 3 of the SFC Code provides that an intermediary should have and effectively employ the resources and procedures that are necessary for the proper performance of its business activities. The book building conduct requirements build on this principle by setting out provisions for specific requirements relating to Chinese walls, the appointment of non-syndicate CMIs, and surveillance and monitoring. CMIs are required to have effective Chinese walls to prevent the flow of price-sensitive or confidential information to staff performing different activities and to prevent or manage conflicts of interest. They also need to have wall crossing policies and procedures in place. The senior management of a CMI is required to review certain types of orders and allocations, including proprietary orders of the CMI and its group companies, unusual investor orders, for example, orders which appear to be related to the issuer, and share allocations which are subject to restrictions under the exchange's listing rules or require stock exchange consent. When appointing a non-syndicate CMI to assist with distribution, CMIs are required to exercise due care, skill, and diligence in selecting and appointing the non-syndicate CMI. CMIs are additionally required to conduct regular independent surveillance and monitoring to detect irregularities, conflicts of interest, leakage of confidential information, and non-compliance with the applicable regulatory requirements and their internal policies and procedures. An OC is required to report on a timely basis various information to the SFC, including any instances of material non-compliance with the listing rules related to, for example, the placing activities conducted itself or by the issuer client, any material changes to the information it previously provided to the SFC and the exchange, the reasons for ceasing to act as an OC in a share offering transaction, and any information required by the SFC. This reporting requirement includes, in the case of a share offering, any decisions made by the issuer client that amount to any material non-compliance with the listing rules. Also, in order to assist with the identification of arrangements that substantially differ from market norms, OCs are required to provide certain information to the SFC by no later than 4 clear business days prior to the listing committee hearing for an IPO. And this information includes the name of each OC participating in the IPO, the allocation of the fixed portion of the fees paid by the issuer to each OC, the total fees as a percentage of the gross amount of funds raised of both the public offer and the international tranche to be paid to all syndicate CMIs, and the fee split ratio, the ratio between the fixed and discretionary portions of the total fees to be paid to all syndicate CMIs in percentage terms. The OC is required to notify the SFC as soon as practicable of any material changes to any of this information. Other CMIs are required to deal with the SFC and the exchange in an open and cooperative manner and to provide all relevant information and explanations as required under applicable law or regulatory requirements or on request. I'll now look at the listing rules that reflect the book building conduct requirements in relation to new listing applicants. So Appendix B10 of the Stock Exchange's Guide for New Listing Applicants, which was published in January 2024, sets out a summary of the listing rules that apply to CMIs, OCs, and sponsor OCs. The relevant listing rules apply to the same types of offerings as the SFC's book building conduct requirements, reflecting the push for syndicate structures and fee arrangements to be determined at an early stage. However, there are no specific provisions in the listing rules relating to the placing of debt securities, although intermediaries are expected to comply with the book building conduct requirements, standards of conduct when involved in placing debt securities. Under the Code of Conduct, CMIs and OCs involved in book building and or placing activities in Hong Kong must be appointed under a written agreement before they conduct any of the activities specified in paragraph 21.1.1 and 21.2.3 of the SFC Code. That is, any of the activities that require them to be appointed as a CMI or an OC in a share offering. The written agreement is required to include their roles and responsibilities, the fee arrangements, and fee payment schedule. These requirements are being codified in the listing rules in Main Board Listing Rules 3A33 and 3A34 and GEM Rules 6A40 and 6A41. The Code also requires OCs to be appointed at an early stage. In the case of an IPO, the OC needs to be appointed no later than 2 weeks after the submission or refiling of the listing application, and in any event before the overall coordinator conducts any specified activities. Of course, this is subject to the additional requirements in relation to the appointment of at least one sponsor OC for main board IPOs at least 2 months prior to the submission of the listing application under the sponsor coupling requirement. The relevant listing rules are the Main Board Listing Rules 3A02, 3A35 to 3A37, and 3A43, and GEM Rules 6A42 to 6A44. The sponsor coupling requirement doesn't apply to GEM listings. The Code of Conduct requires OCs to advise issuers in relation to the stock exchange's restrictions on placing shares to restricted investors. As I mentioned earlier, OCs also have responsibility regarding the proper management of the price discovery process, the order book, and the allocation process. The OCs engaged in connection with an IPO on either the main board or GEM must provide a declaration in the form of Form E, which is published in the Regulatory Forms section of the Stock Exchange website, that a book building process was carried on in respect of the placing to assess demand for the shares, and that the Stock Exchange's placing guidelines set out in Appendix F1 to the Main Board Listing Rules or GEM Listing Rules 10.12 to 1016B have been complied with. This declaration must be submitted to the exchange on FINI before the listing applicant's shares commence dealings on the exchange. To assist CMIs in discharging their obligation to comply with the exchange's placing guidelines, Main Board Rules 3A46 and GEM Rule 6A48 require the written engagement agreements entered into by a listing applicant with each syndicate CMI to specify the obligations of the listing applicant and its directors, to provide the syndicate CMI with a list of the directors and existing shareholders of the listing applicant and their respective close associates and any nominees engaged by any of them for the subscription or purchase of equity securities or interests in connection with the listing. This information must be provided to syndicate CMIs as soon as practicable, and in any event at least 4 clear business days before the date of the listing applicant's listing committee hearing. Under the Code, OCs are required to advise the listing applicant to provide this list to syndicate CMIs. Paragraph 19 of Appendix F1 to the Main Board Listing Rules and GEM Listing Rule 1016B require the issuer to document the rationale for its decision on pricing and allocation, particularly where the decision is contrary to the advice or recommendations of the OC. The listing rules also require the OC to inform the SFC and the exchange if any decision made by the listing applicant amounts to non-compliance with the listing rules related to the placing activities conducted by it or the listing applicant. This is to complement the OC's responsibility under the Code to explain to the listing applicant the potential concerns if, in the case of a share offering, the listing applicant's decision may potentially lead to a lack of open market, an inadequate spread of shareholders, or may negatively affect the orderly and fair trading of the equity interests in the secondary market. It should be noted that the listing applicant is generally expected to make these decisions in accordance with the overall coordinator's advice and recommendations. The book building conduct requirements contain provisions prohibiting CMIs from offering rebates to their investor clients or passing on rebates provided by the listing applicant to their investor clients. Although rebates to investor clients through the reduction of brokerage commissions were already prohibited prior to the 2021 changes to the listing rules, additional requirements were added to the listing rules to reflect the prohibition on rebates under the book building conduct requirements. In particular, under Note 2 to Main Board Listing Rule 1208 and Note 3 to GEM Listing Rule 1613, each new applicant is required to confirm that no rebate has been provided by it, its controlling shareholder, and directors and the syndicate members to any placees or the public in the announcement of the final offer price and the allotment results of the IPO. The book building conduct requirements also prohibit CMIs participating in an IPO from allocating shares to their clients for a price that's lower than the price stated in the listing document. Under Marketing and Independence Statement Form D of the regulatory forms to the Main Board and GEM listing rules, all OCs, syndicate members and other distributors involved in a placing involving book building activities conducted on a new listing are required to certify to the stock exchange that the consideration payable by each placee for the shares purchased by them is the same as the final offer price determined by the listing applicant, plus any brokerage, FRC, transaction levy, SFC transaction levy, and trading fee payable. Each OC, syndicate member, and distributor involved in the placing is also required to submit a list of placees to the Hong Kong Exchange on FINI. Placee lists must set out the information required by paragraph 11 of Appendix F1 of the Main Board Rules, that is, the names, addresses, and identifying information of each placee and the amount taken up by each placee. The listing rules also contain various reporting requirements that reflect the codes of conduct's book building conduct requirements. Main Board Listing Rule 3A37 and GEM Rule 16A44 require listing applicants to publish an announcement on the exchange's website, setting out the names of their OCs on the same day as they file their listing application and publish the application proof. Main Board Listing Rule 3A41 and GEM Rule 6A46-2 require a further announcement to be published on the appointment of any additional OCs or the termination of the engagement of an existing OC. Listing applicants permitted to make a confidential filing with the stock exchange are not required to announce the names of their OC when they file their listing application, but will be required to publish an announcement naming their OCs on the same date as they publish the post-hearing information packs on the Exchange's website. In relation to new listing applicants whose hearing dates are being confirmed, Note 2 to Main Board Listing Rule 911.23a and Note 2 to GEM Rule 12.23AA require a sponsor OC for a Main Board IPO or an OC for a GEM IPO to submit a written confirmation providing certain information to the Exchange no less than 4 clear business days prior to the Listing Committee hearing. This is the same information as is required to be submitted to the SFC under the Code. That's the name of each OC, the fixed fees to be paid by the listing applicant to each OC, the total fees as a percentage of the gross proceeds to be raised from the IPO, in respect of both the public subscription and the placing tranches to be paid to all syndicate CMIs, as well as the ratio of fixed and discretionary fees to be paid to all syndicate CMIs in percentage terms. If there's any material changes to the information previously given, the sponsor OC or OC must notify the Exchange together with reasons for the changes as soon as practicable. Listing applicants do not need to submit the information separately to each of the SFC and the Exchange. Instead, the information submitted to the Exchange will be passed on to the SFC in accordance with the Securities and Futures Stock Market Listing Rules. There are provisions in the listing rules requiring listing applicants to disclose in the listing document the total fees as a percentage of the gross amount of funds proposed to be raised in the subscription tranche and or the placing tranche, and the ratio of fixed and discretionary fees paid or payable to the syndicate members. This requirement is set out at paragraph 3b of Appendix D1A to the Main Board Listing Rules and GEM Listing Rules, respectively. Paragraph 3a of this appendix requires disclosure of the sponsor fees in the listing document. As I mentioned earlier, the fixed fees payable to syndicate CMIs must be determined at the date of their appointment by the listing applicant and must be set out in their written engagement letters as a percentage of the total fees payable to all CMIs participating in the offering. In practice, the listing applicant also needs to determine the total amount of discretionary fees payable to syndicate CMIs at the time of appointing the first CMI in order to set out its fixed fee entitlement as a percentage of the total fees, which include discretionary fees. As to the determination of the allocation of discretionary fees, the listing applicant needs to have determined the allocation of the discretionary fees to each CMI before it submits the issuer's declaration Form F, published in regulatory forms through the FINI platform. That's after the issue of the listing document, but before the grant of listing approval. In the issuer's declaration, the listing applicant has to confirm that the absolute amount of discretionary fees to be paid to each syndicate CMI has been determined and communicated in writing to the syndicate CMIs. It must also confirm in the issuer's declaration that the schedule for the payment of the total fees payable to each of the CMIs has been determined and communicated in writing to the syndicate CMIs. Where a listed issuer conducts a placing of shares, Main Board Listing Rules 3A41.1 and 910B and GEM Rules 6A46.1 and 1208 require any change in the OC to be reported to the Exchange as soon as practicable. Under the listing rules, separate marketing and independence statements in the form of Form D in regulatory forms must also be submitted to the Exchange before dealings commence. Since the introduction of the book building conduct requirements in August 2022, ASIFMA updated various guidelines and template forms taking into account the book building conduct requirements and these are available on their website, such as guidance on provisions applicable to OCs and CMIs and underwriting agreements for Hong Kong IPOs, template Hong Kong IPO appointment letters for OCs and CMIs, as well as template communications that intermediaries may consider sending to relevant prospective investors other than CMIs or private banks prior to commencing book building or placing activities in respect of their obligations under the new book building conduct requirements. ASIFMA, which stands for Asia Securities Industry and Financial Markets Association, is an independent regional trade association comprising a diverse range of over 165 leading financial institutions from both the buy and sell side, including banks, asset managers, professional service firms, and market infrastructure service providers. So that brings me to the end of the formal part of this webinar. Thank you for joining me today, and I hope you enjoyed the webinar. Look forward to seeing you again soon. Bye.